Welcome everyone to the REALIntell videocast. My name is Leone and I'll be your host today. Today what we're going to talk about is cap rate trends, and basically this is the outlook for 2015. And what's really interesting here, and what we're going to discuss a little bit further, is where we think the cap rates are going to go. So right now here you see that we're looking at, on the bottom we have the years here, and we're looking at the primary, secondary, and tertiary markets. And for those who aren't familiar, primary markets are primarily New York, San Francisco, Los Angeles. The really heavy-duty, real dense markets that mostly institutional investors as well as international money usually goes into, and that's because they're usually the most common, most safer bets in terms of what assets they have. And then as you get smaller, you go into the secondary market. Secondary markets examples would be Salt Lake City, Utah, or Charlotte, North Carolina. And then smaller yet, you can go into tertiary, which are, let's say, maybe like a Winston-Salem. So the type of market is very arbitrary. So it's not like everybody's definition of primary, secondary, and tertiary are going to be the same. But just understand that it will be really have to do with a size as well as potential. So what you see here is in 2006, 2007, you can tell that the difference really between the primary, secondary, and tertiary markets, right in there, wasn't much different. There wasn't much difference between one to the next to the other. But here in 2014, there's quite a bit of distance. So what does that tell us? I mean, primarily what that's telling us is that there's been a lot of investing in that primary market, and primarily because the money interest rates are quite low. There is a lot of money out there chasing yield. There's really no yield to be gotten. So they're basically looking at real estate as the answer, and that's really driven the cap rates down. And the reason that's happening is because we have also international influence as well. A lot of parts of the world are very unsettled at this point. Russia, China, parts of Europe. So a lot of the money that usually would be going there is also coming into U.S. assets, specifically in those core or primary markets. And that's driven the cap rates down to, you see here, about 5%. Here in New York City, it's even lower. It's more in the 4%, and there's been cap rates selling even under that. So, but if we look at the secondary and tertiary market, they haven't quite come down that far. So what we expect in 2015 is that people who aren't really getting the yield in the primary or core markets are going to start looking at secondary and possibly tertiary, and those cap rates should follow suit, meaning that they should get also lower as we see 2015, 2016 roll out. Now, will primary cap rates go even lower than the 5%? Definitely possible as well. So downward trend for all those cap rates, barring any kind of unforeseen circumstance such as a big interest rate hike or interest rates shooting back up. So that's what we're looking at in that regard. Now, if we look at the actual class of the product, Class A versus the Class B/C, you're sort of seeing the same thing here. Back here in the 2005, 6, not much gap. You could see here 2004 or 2005 actually is almost the same. And here in 2014, again, a bit more of a gap. So primarily because Class A has been hot. Class A has been the core area to look at. So, again, we look to see the Class B/C getting closer to the Class A, so that gap is going to close. What does that mean as an investor? As an investor, obviously, if you own Class B or Class C assets, I think you can probably ask a bit more, especially if you're in a market that's going to demand a lot. If you're in the market for it, you can probably get away with purchasing and still benefit for some downward trend going forward. Now, the cap rate itself, and I just wanted to put in this slide in case there's some folks out there who might not be familiar with the term. Probably should have went over this beforehand, but very quickly, most people who are investors will know this term. If you don't, you really need to. It's your net operating income. If you divide it by the cap rate, you're going to get your price, and that's the price that theoretically you should pay for the property. Net operating income, if you see here up in this corner, we have the definition, and it's basically your rental income, and you're going to take out any vacancies, so really what you actually get at the end of the day. And then from that, you're going to pull out your operating expenses, and that's going to be your net operating income. And cap rate would be specific to the class of the product, so if it's Class A, Class B, Class C, and then also the location, which market it is. And it's usually determined by the demand. And the demand, and looking at past sales around that time, you can get a sense of what a buyer will be willing to pay in terms of cap rate for that property. So another area to discuss before we leave here today is the cap rates themselves. I mean, the capitalization rates, basically, you go into, let's say, a market, and the realtor or the broker tells you it's, we usually are seeing 8% cap rates here. Well, 8% cap rates, based on what? So you basically look at what maybe some of the sales that have occurred, and you start to calculate different expenses that you see you're being provided with. And you now have to make a determination as which is this cap rate correct, or is this cap rate not really meaningful? And that makes a big difference in what you pay for the property. So let's look at some of the areas to really look at and focus. Data services. Now, this is your LoopNet, your CoStars, primarily what maybe someone might be giving you off of, let's say it's a multi-unit, an MLS, or what they have. Well, you need to take this with a grain of salt. Part of the problem with these data services is that they gather their information in different ways. Some of it is basically by verbally just asking someone. Other ways are, they primarily get input from brokers. So these cap rates are only as good as what the data service is that's providing them. So you shouldn't use just one data service, and if you do, you need to really validate what that data service is saying. The other point we see here in the second bullet is that the sales information is correct. Sales information, if you take the sales information and use your net operating income, that theoretically is going to give you the cap rate. So if you look at sales and the sales number is wrong because, let's say, the broker hasn't provided the correct number, or maybe they weren't able to get the exact number, or there may be some extenuating circumstances. There's also non-disclosure states like Texas, where they don't have to provide that sales price. So a lot of times these data service companies try to get that data price in a different way, and how they always do it is not really validated. It's just someone telling them what the price was. So you need to be careful about that. And then also older cap rates. If you're looking at cap rates from 2-3 years ago, they obviously don't make any sense anymore because they don't apply. But in a lot of markets, there haven't been enough transactions to get rates that you can consistently look at and be comfortable with. So that makes the cap rate a lot less meaningful, especially after a certain number of months old. And the last piece is, and this is very much specific to the property type that you're looking to purchase, they don't always reflect everything that's in that value that the person might have paid. And this is especially true for hospitality and those types of businesses, because there's a lot more components involved in the total price of those products. And it could be the same with the property that you're looking at. So if you've got only a handful of cap rates, and some of them are, sort of these type of properties, they really, at the end of the day, aren't going to mean much. So you're going to have to rely on other metrics to determine what the actual value might be. All right, well, that does it for today. We'll leave with our quote of the day, and today's it's, "You have to learn the rules of the game, and then you have to play better than anyone else," by Albert Einstein. And as real estate goes, I think this is really apt because for sure in real estate, there are different rules of the game, and some people are more clever or more persistent or just better, whether it's property management, whether it's identifying deals, whether it's negotiating. And as much as you can become better, even incrementally better in each and every one of these areas, the overall combination of that effort is going to pay off. So let's get out there and do some deals, and best of luck with you, and have a productive day.